Let me tell you something. There is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time. Because at least as a rich man, when I have to face my problems, I show up in the back of a limo wearing a $2,000 suit and a $40,000 gold fucking watch. Fat boys, duke it out. Hit him. Hit the fuck off of me. Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong.
We are about to enter the last trading week as for March, so welcome back for another weekly market recap. I've been a bit away from markets this week for reasons which are more related to real life, and if you watched the last week video, especially in the beginning, you should kind of guess why. At the end of it, it's all good. I mean, nothing really dramatic, but I didn't have much time to keep up with markets. So I had to catch up on a Friday and this morning a little bit. So, but, beyond me and my issues, let's start out with the economic calendar as usual. Now, we started out on Monday with retail sales coming out of the US. And although a little bit of a clarification here, which is interesting, and it was interesting for me as well. Now, I've always been particularly skeptical of retail sales because they do report the data in nominal terms, okay? So they don't adjust it for inflation. On the other side, it is also true that if you just check the headline and then you compare it with this control group that they got, it tells kind of a different story, not massively different, but a little bit maybe. So in order to understand this, it's pretty simple. If you understand the definition and the difference in between the two definitions of CPI, the headline, and the core CPI, right? Excluding food and energy, this is basically the same. What the control group does, it's basically excluding components like materials and garden equipment or motor vehicles, and especially when it comes down to motor vehicle parts, or gas station type of components, just because these are expenses that you don't really kind of make every day, right? You don't buy a new motor vehicle every day, or you don't repair your vehicle every day, okay? Same as you don't buy materials for remodeling or renewing your house every single week, right? So they try to take out those components in order to get a bit closer to what is the day by day condition of the consumer, and therefore what is reflected in the retail sales. And it looks like, although retail sales over the last 2-3 months kind of plunged a little bit, the headline, right? The control group, at the end of it, it just moved in a range, but it didn't really go anywhere. Not much down, but not even up. So still stuck in a little bit of a limbo right now, which is kind of, to me, it's like, yeah, I mean, if you check it from the standpoint of the consumers, it's like, we're struggling a bit, but we are hanging in there yet. And it might be why the economic conditions didn't deteriorate so fast, right? Although, you can never tell when they are gonna really materially and substantially slow down like a lot and all of a sudden. And, if you do remember something like this, right? You see that at least standing to the Atlanta Fed, they can actually deteriorate pretty fast. Although remember, we are always talking estimates, right? So not hard data for now, not yet at the very least. Beside that, what we got on Tuesday was, yeah, for the US, not much. Some data for the housing market. There was the inflation read in Canada, which came in where? 2.6 year over year, right? So a little bit of a reacceleration compared to the previous read. It was also above consensus, so yeah, maybe it might be the tariffs are striking in now. Maybe the common narrative would suggest that, but again, it's just probably a blip on the radar. Or, as usual with these data, I'm more concerned about the overall trend over a decent amount of months rather than one single data point. Nonetheless, it was relevant, right? Uh, so the big event of the week, of course, FOMC meeting, and we've seen they didn't move rates; they kept rates where they were, and it was widely anticipated. We have checked the Fed funds a lot of times over the past few weeks just to kind of have a little bit of a confirmation from the market. Not that I'm completely trusting the Fed Watch tool, but at least it's better than nothing, right? I didn't follow the press conference, but I just catched up with it, reading bits of it here and there. It looks to me like at the end of it, it was a little bit of the same. Just if you read the SAP, the what was that? The summary of economic projections that the Fed releases, right? It looks like now they are shifting to a bit more of a dovish tone. Okay, so they're already talking of slowing down the rate of QT, so rolling off their balance sheet a bit slower. And usually when they do it, it's because they are preparing to transition in the other type of phase, which would be not necessarily QE right away, but it's just a preparation just in case we need to do it. We slow down QT now and then we are ready in case of emergency or in case the economy, the market requires that to start QE. Yeah. Uh, I don't honestly know why the Fed keep on releasing the SIP or the dot plot, because if you check historically, more often than not, they're wrong. The old thing started out with Bernanke back in the days, and I guess, over the long run, it made the Fed a bad service, in my view, because now you can actually pin them down to their projections and actually call them wrong. While, if they just kept on being like kind of like Jay Powell usually does, like to be data dependent instead of trying to forecast what the future is going to be, well, maybe they would have been in a much safer place, at least from a reputational standpoint. But again, that's not up to me to say. So going ahead, we had what unemployment in the UK, which was kind of stable, pretty much, and then initial jobless claims on Thursday for the US. Still, if you check the continuing jobless claims, they're still trending to the upside, very slowly though. So again, the labor market, sorry, might show some cracks, but it's not really broken yet. So again, just bear in mind, just because you see the cracks, it doesn't mean the entire uh, structure is going to collapse tomorrow morning. And we didn't really have anything relevant after these. I guess, at the end of it, the week was relatively calm. It's nice what you see now on websites like Polymarket, right? The online betting, where they attribute a 100% type of chance that the Fed will stop QT in May. Uh, Maybe, who knows? If you look at these, like trying to run a parallel in between the way they run the balance sheet and the way they manage interest rates, it looks like as for now the market it's not looking at a cut in May. But again, there is more than 1 month to get there. What they are looking at is a cut in June. Guess what? So could this be like we slow down or we stop QE first, and then if we need it, we just drop rates, bring back QE, and we follow the usual playbook as for when the markets are in a particularly dire situation? Who knows? We just need to live and see. But other than that, let's check some charts and let's start out with what yields did in this week of FOMC meeting, right? So Nothing. I mean, if you really want to zoom in, maybe there were some good swings here and there. But as for last week assessment, they're still moving in this range. So up until the point we get out, one way or the other, I don't have any particular bias on yields. Same for the bonds, right? Uh, they're still moving in between the previous range, all of them basically. Um, to me, right now, it's just a matter of seeing which one is holding up relatively better to the other. And as you can see, of course, the short end of the curve, it tends to be a bit higher in this case when it comes down to the underlying asset price, right? So, I mean, conversely, yields are on the short end should be lower, and we've seen that's totally the case, while they remain a bit higher on the long end. Honestly, if you try to assess it on a week by week base, I don't have a particular read into it. If not, my long-term thesis of lower rates into the future, but it is always a bit of a hit and miss in trying to determine that type of time window. Would it be 6 months? Would it be 18 months? Would it be 3 years? Again, so I'm just monitoring this and see if they move like a lot and for what reason. But other than that, at the current moment in time, I'm not particularly interested in being kind of like a hawk watching these charts right here. Let's check instead the dollar, the DXY. Guess what? It looks like, I mean, it was a bit sloppy, right? But we finally got a bounce attempt originating from where? Oh, the long-term macro range AQ. And as mentioned last week, we got this thin leg above. So wouldn't be a lot to ask to just try to feel a bit of it. It doesn't have to feel it all, or at least not all in one blow, but maybe coming up around 104, 104.5 in this region wouldn't be unusual. And again, it could actually get up to 105 even, wouldn't be surprising. But considering how it's moving right now, I think the drawback might be a bit sloppy. As the bottoming formation was sloppy, even the drawback could be sloppy. So it might be you see it coming back down Monday, Tuesday, then trying to keep on going higher. I'd say up until the point we can hold these current lows, right? You might see a little bit of a protracted bounce in here as for the DXY. And of course, as for the rest, so the other currencies, or at least the majors, we are looking at the same type of situation as for the previous week. Canadian dollar, it's not getting any love yet. The euro finally seems like mm, I would I would just wait a bit longer to call it, but it looks like it started to pull back a little bit. Now, we'll see what type of a pullback it might got get, sorry. But as for now, up until the point we can stay above oh 08, maybe not a lot. If we break oh 08, maybe say it's like the inverse of the dollar, right? Maybe we can try to draw back a bit of this thin leg. The pound, it's my view relatively stronger than the euro for now. So uh, I would be probably leaning toward the pound if I had to play some long bets. But at the end of it, they're very closely correlated. So they should move kind of in the same type of fashion, right? Uh, Not spending time on BRICS currencies today. They just did basically they kept on doing what they were doing last week, so not a lot. What about oil? Yeah, so again, oil looks like we are trying, even in here, to put together a bounce. And the premise was if I was particularly bearish on oil, now that we are approaching these levels right here, I should start to be a bit more neutral. And it looks like, at least for this week, Monday started out with a rejection. We came back all the way down to the previous type of level or region area. You call it what you want. And we just reversed on Wednesday, Thursday. So, Monday already tapped this area out. Rejection wasn't really convinced because when you see a rejection like this, you would expect continuation sooner rather than later, in my view. We did actually reverse. So intra-week, I would take it a bit more as a sign of strength, at least for the coming week. And again, strength, not in the sense that oil would shoot back up again to 75 in a week, but maybe a bit more of this type of behavior, a bit of a drawback, a grinding into this area and not moving a lot. At the end of it, even if it doesn't really play out like that, you got clear points of invalidation, right? Below these lows, probably above this point right here, this area, this previous top on a daily, and then you can start discussing different outlooks or scenarios for the short term. But up until the point, probably not. Let's check gold. Well, gold had a nice weekly close last week on a Friday, and it got continuation throughout this week. Futures traded up to what, 3,064? Well, let's call it 60, just rounding up the numbers. And we got a bit of a retracement on a Friday, which again, it's not bad. I mean, we didn't really break anything from a structural standpoint, even with this dump on a Friday. And, it was kind of a spike, but most of it was recovered before the close. So I guess, after a run like this, you might see a bit of a consolidation. I wouldn't be unusual, but we are checking gold for what? At this point, it's been 6 months, 7 months. This is just how it moves, right? It goes up, it comes back down, it goes up. It's very efficient in the way it's moving. So up until the point you see it moving like this, yeah, you might get that wicks where it just, it goes anywhere. And then you got that week or 2 weeks where it just pump and it creates new levels and it's just auction to new levels. That's kind of the behavior of gold recently. So I wouldn't necessarily expect something different in the very short term. That would be my take on it. As for Bitcoin, we were expecting what in Bitcoin? A bounce, right? Same as we were expecting a bounce in the dollar and we were expecting a bounce in equities, but more on that later. So I think, although at the end of it, the price behavior was kind of on point. We were expecting to see Bitcoin tapping in a bit more into this level right here. If you remember last week video, the only problem might have been we were expecting it to happen on Monday, Tuesday. Ended up happening on, well, basically Tuesday, Wednesday. So maybe a little bit off on the timing, but if you show me one person which can time the market correctly 100% of the time, uh, yeah, I'll shut I'll shut my mouth. I think even in Bitcoin, we tapped in a good area of resistance. There was a price inefficiency in here. There was this point of release in here, but we didn't get a follow through yet, right? So we're still drawing back a little bit. And I know I do sound like a broken record, but if you check it out, it looks like the entirety of the market, it's just moving this way. We got spikes in volatility and then volatility cooling down and the market goes a bit quieter and you got lesser uh, impulsive and expensive, no, not expensive, expansionary, well, moves which are just expanding one way or the other. Directional moves. That's the term I was looking for. So I would say it's kind of cool that we've seen the rejection, but we didn't really violate these laws for now. So I guess it's kind of clear what you want to look for. Can we reaccumulate in here? and finally defeating the initial rejection and starting to climb even higher than these? Or will you see next week these price action actually shattering, breaking the lows, and then these kind of intermediary lows right here, and aiming at revisiting the previous lows? If not, again, as it was the case, to go for slightly new lows. It remains to be seen. I think if we check the other layout as we've done last week, nothing really changed around in my view. The moving averages are still pointing toward the same direction. They still got the same posture. We tried, if you check these purple line right here, that's the 200 days moving average. We tried to rally above it. We lasted what, 1 day? The following day we were already back below it. And there is still that case for a bottoming formation, right? This one right here. Uh, I don't know. It was just some sort of a study case, but if you check how the indicators are shaped out right now, it might be that even if we drop, we might we might not create a lower low on the indicators, and therefore at that point you can really start to look for your usual bottoming formation on a daily type of time horizon. And it depends on how you define a swing low or a swing high, or how you do define a divergence actually actionable and whatnot. But that's the time where you want to check your playbook and see if we are there for the big bet bounce. Okay. As for now, there's nothing really definitive on either of these charts. None of them. It's a clear picture one way or the other, right? So the usual pause before getting into stocks, and I'm gonna see you back in 3 seconds. All right, let's check out these stocks. If you remember last week, we were looking at the equity market and we were looking for a bounce for different reasons. We are not gonna talk about them all right here, right now, but if you just want to know, check last week video. So, did we get the bounce? Meh. I mean, it wasn't a huge bounce. I guess when you talk of a bounce after a 10% correction, people might think of a sharp type of a rally. Um, Look, the point about timing comes back into play, even in this case, in my view. Did we have that huge, super sharp and nice bounce? No. Did we at least stop bleeding out and trying to get a bit more stable with this price action? Yeah, we did that. So don't get confused by the fact that this candle on SPY, uh, it's bearish colored, right? It's just because we gap down at the open, so the open is right here, and we opened below the previous daily open, and then we closed below the previous daily open. But at the end of it, the candle should be read as for we opened up and we just went up, kind of like in these, right? That is the type of read you would want to have beside the color scheme there. And if you check the futures, for instance, although they, of course, they have a different type of a print because they follow different schedules, but that's the type of behavior you got on SPY too at the end of it. So with that being said, it's not like we're out of the woods yet, in my view. But at the same time, I think there is still a potential for a bounce a bit larger than these. Because I was just starting to check a few sources here and there. Not to say that the sources that I got are 100% right, but they just give you a bit of a starting point to start to build up a narrative or a potential scenario, right? So it looks like, at the least standing to sentiment trader, and we're getting back to the sentiment factor right now, but it looks like right now the so-called smart money are particularly confident in this market. While on the other side, the damned money are a bit more worried about this market, which, if you think back, it's what we've seen when we were looking at different sentiment metrics, like the consumers were scared, the retail investors, they were a bit scared. The thing is that even if they were scared, it looks like, at least that's what it looks to me, right? But it looks like we have been going through 10, 15 years of market uh, quote unquote manipulations that it looks like now the reaction, it's not about selling all and going hiding into a cave, but it's more of a wait, the market is down 10%. I gotta buy it because if it goes down another five, Jay Powell will step in and will backstop the market. So it looks like this moral hazard that we got going around right now, it's really what keeps the markets from plunging a lot, which is based on the simple fact that it doesn't matter. I can buy it because we are already down 10%. If it keeps on going, the Fed will need to step in. So there is, again, the Fed put once again. And there are many puts, right? There was the Fed put. Then recently we got the Trump put after elections. We've seen how it played out, right? 10% correction. But again, which is, again, as we have checked, a 10% correction, it's normal. There's still, this is not a bear market yet. Could become one, but it's not right now. So I'm still confident in a little bit of a bounce based on these premises. Now, if you instead start to check sources like the AAII, which is a silly acronym to say the American Association of, what was it? Individual investors, I think. Yeah. It looks like the bear or the bearish component of it, or the bearish read or sentiment grasp of it, it's reaching up into levels which in the past, and especially over the last 15 years more or less, they coincided with good bottoms in the market. And I think I've seen it. I'll try to retrieve it if I can. But it looks like they also put out the average time to see the actual bounce or bottom and the price excursion in percentage terms. So uh, the ideal type of rebound in percentage terms you should, at least you've seen in the past. It doesn't mean that you're gonna see it now, but at least that's what was in the past. Okay, the usual cliche: past performances are not guarantee of future results and whatnot. Or maybe it was the other way around, but anyway, you get the gist of it. But that would be another type of a logic behind it to expect this bounce to at least give it another try. Okay, maybe we do actually revisit the lows and we go for a complex type of low like the one we were postulating for Bitcoin. But I think we are still on the go for a bounce, even if we trade slightly lower than these. Okay, just give it time. Then, of course, you're going to call me back when the market is down another 10%, and you're going to call me a dumbass, which at that point, you will have all the rights to do so. But hey, such is the nature of the beast. Sometimes you get it wrong, sometimes you get it right, but you just keep on going. So, there was another thing which might suggest a bit more of upside in these markets over the coming weeks, not necessarily next week, but I guess you should be aware that the market nowadays is moved a lot by algorithms, computers, right? So the CTAs, the computer trading algorithms, they do move markets a lot because they are just bots at the end of it, programmed to do this or that if they see price moving this way or the other way. Okay, they are set up, and once they see the trigger going on, they don't think about what's going on or why or who is doing what. They just have a routine and they execute that. Okay, which is why you see these sharp spikes in volatility when they are all triggered at once, right? Now it looks like, at least standing to Goldman, right? It doesn't have to be the Holy Bible, but it's still something. It looks like right now they are seeing a position which is really light, in the sense that they already sold like a lot. And when these things actually trigger, they do trade momentum more often than not. So they do trade with the tape, right? Um, you could think at the tape as for the order flow of the market. So the amount of volumes which are coming in one direction or the other. So hitting the bid or hitting the ask, it depends, right? Depends if you are in a downtrend or an uptrend. But these CTAs, they do tend to follow what the market is already doing. They're kind of trend following type of bots. And naturally, by that logic, they tend to exacerbate the different moves you might see in markets. It looks like right now they are particularly on the bearish side. So the logic would suggest if you get a little bit of a change in behavior right here, they are going to need to cover. So they're going to shift from selling into buying. Them, as for any other late shorter around these levels, okay? So it could generate a good amount buying pressure. And you know, Goldman actually gave out a few estimates, which again might be on point, might be not, who knows. But they say in a down tape, they should sell like 4.5 billions. But in an up tape, so if the market actually keep on rebounding, they should be buying 45, 50 billion. And that's just for SPX. So again, it could fuel a decent bounce. Now, how do we get there? Do we go straight there, or do we trade a bit lower first and then we try to get there? That remains to be seen in my view. But I'm not really quitting this idea of a potential bounce. And finally, just remember that if we check the seasonality, we are almost at the end of March, and April should be kind of a good month overall. Again, if you want to trust the statistics. So at the end of it, I'm just sticking to my idea as for last week. I'm still thinking this bounce is not done with, and we might see a bit more, even if it requires to revisit the lows and creating a bit of a, your usual type of W bottom or double bottom, if you like, where you get a low, bounce, another low. It could be equal, it could be slightly above it, slightly lower than that. And then we finally put together the bounce. Let me see if I can actually find an example, kind of like this one, case in point, right? And that was after what? The 2024. Oh, funnily enough, 2024 was one of those instances where seasonality actually failed you, because as you can see, this is the month of April. April was kind of meh. But beside that, you see a low, bounce, get toward the lows, not necessarily new lows or at the lows, but around the low, and then we just bounce for real. So I think it wouldn't be unusual to see some sort of a same behavior. And if you check these assets long enough, you see that indices, they do tend to create these quote unquote, again, complex bottoms. We'll see about that. Might be true, might be not. I don't know. So I think at the end of it, a lot of people are actually a bit scared from these type of recession vibes that once again we are seeing in markets. Look, I don't know about recession. I think there are many risks, and I talked about them quite extensively over the last 6 months. The point is always the same. First of all, the best you can do is just being prepared and hedge yourself for eventual risks, right? So taking care of your downside exposure or risk. The second, at the end of it, and for many people it's kind of hard to deal with, but you're never going to know when a recession actually hit. Or at least standing to the MBR, you're going to know it when the recession is most likely over, right? That's how they usually roll with it, at least since this type of recession metric was established back in what, the 80s, the end of the 70s, most likely. And again, I mean, the usual lag they got in calling recessions, it goes from 6 months up to 12 months, 14 months, 16 months. So do you really need someone else to tell you when the recession is coming? Yeah, they're gonna tell you when the recession is, it's most likely already passed. And that's the silly part of it. You might just step out of the market, or you might just avoiding buying at the best moments. If you check, how the economy actually behaves. For instance, the GDP type of read, and with GDP, with growth goes corporate revenues. With corporate revenues goes stock market over a long enough period of time. So just try not to be caught up in these narratives going around, because you never know. All right. I guess that's it for today. It might be this time for real a bit of a shorter video, maybe below an hour mark. As I said in the beginning, it was a particularly rough week for me. I'm still feeling like I need to get back in sync with markets. We'll see how next week goes. Hopefully better than these. And with that said, we are gonna keep on monitoring these markets over the coming weeks. Waiting for it. Just have a good rest of your weekend. Have a good Sunday. And as usual, be nice and be cool. Nils out.
So you listen to me and you listen well. Are you behind on your credit card bills? Good. Pick up the phone and start dialing. Is your landlord ready to evict you? Good. Pick up the phone and start dialing. Does your girlfriend think you're a fucking worthless loser? Good. Pick up the phone and start dialing. I want you to deal with your problems by becoming rich. All you have to do today is pick up that phone and speak the words that I have taught you. And I will make you richer than the most powerful CEO in the United States of fucking America.